The headlines today read like a stress test for the global economy. Tesla also just greenlit a pay package that could be worth $1 trillion to Elon Musk if all his milestones are met. And Bitcoin slipped below the psychological critical 100K level. And U.S. households, well, they're on a fresh record in debt of topping $18 trillion. That mix of extreme corporate bets, crypto volatility, and household leverage is exactly the kind of environment that separates the traders from the builders. If you want to survive and thrive, and you need context, conviction, and a clear plan, stick with me. What's up, family? It's Coach Masi, and you're locked into the Daily Huddle. This is where we break down the biggest financial news, Bitcoin insights, and market trends so you can stay informed, disciplined, and ready for opportunity. Let's dive in. Quick reminder, if you value clear market breakdowns and no nonsense Bitcoin analysis, smash that like button and hit subscribe to the channel if you haven't already. This is for educational purposes only and not financial advice. So let's start with the largest corporate story today. Tesla's shareholder approved pay framework that ties massive compensation to delivery, valuation, AI, and robotics outcomes. Well, at face value, this is a statement. Leadership is doubling down on an all-in growth strategy. At scale, it also concentrates enormous directional risk in one person and one playbook, Elon Musk. So why does this matter beyond the headlines? Well, one, concentration risk. Corporate value becomes hyperlinked to execution. If Musk hits milestones, there's enormous upside. But you have market psychology. When investors reward huge pay packages, they are signaling a tolerance for big single name bets. That leaks into valuations across growth techs. That could all be changing things. Is this a giant moonshot? Is there multiples of net worth coming? You need to watch for signals, insider selling rules, milestones that are being hit and clarified, any table changes, large funds that reduce exposure, institutional increases and buy-in narratives. You see, practical thinking is happening. You need to know the timeline, investing, and milestones if you're a Tesla investor. You got to understand adoption and regulatory outcomes and multiple expansion. Big executive bets require a big margin of safety. Bitcoin's move, though, on a different note, is all about liquidity and sentiment at the moment. You see, liquidity withdrawal is happening. Higher yields and risk off flows pull institutional capital, reducing natural buyers. And there's some derivative stress. Futures, funding, and options gamma can force swift moves when volatility spikes. And you got to watch for correlations. Bitcoin often correlates with equities, not gold, which could amplify downside. So there's a lot of different signals. You're looking at hash rate and distributions and net outflows, cold storage and accumulation. There's a lot of things going on. We're seeing long-term wallets that have been selling a ton of coins lately. So for context, corrections of this magnitude have historically set the stage for deeper accumulation by long-term investors. But history is a guide, not a guarantee. You need to understand your edge is having process to know what would change your mind and set perimeters ahead of time. You see, now the largest systemic story is this. U.S. households, on a different note, they hit $18 trillion of debt. Keep in mind, their debt is composed of mortgages, about 13 trillion, auto loans, 1.7 trillion, student loans, 1.7 trillion, credit cards, 1.2 trillion. Things are going crazy. Credit card debt alone is up 50% since 2020. So why is this crucial? Monetary sensitivity. Households carry rate risk. When rates rise, mortgage resets, HELOCs, and variable rate products bite. Consumers are fragile. That high debt and income, well, that turns into pain. Then you got credit contagion. Delinquencies can grow non-linearly. Job losses, pushing pressure on banking and scrutinized markets and household incomes. And you really got to keep an eye on delinquencies, credit card delinquencies, cars, just everything when people are borrowing, especially loans issued to subprime borrowers. Those micrometrics often flash well before macro cracks widen. So you need to understand that a high household leverage magnifies macro shocks into personal financial stress. Your capital preservation matters more than speculative moonshots. And you need to know that. So anyways, I'm going to connect the dots. Tesla's big bet signals there is still appetite for hyper growth narratives. Bitcoin's retreat signals liquidity is tightening. Household debt levels show how fragile consumer demand is. And the net effect is a feedback loop. Reduced consumer demand from high household debt can pressure earnings. Earnings pressure with high interest rates reduces the valuation that multiple investors will pay. Reduced valuations between that, like stories like Tesla, are more sensitive to execution risk. And you don't want execution risk because that includes Bitcoin. You see, that is why we are watching correlations right now. Markets do not move in isolation. A blowout in leverage, a rise in yields, or a sudden, consumer pullback can magnify losses across stocks, crypto, Bitcoin, credit. You got to really watch the money markets, the inflows, the repo rates, bond spreads. It's all happening. But don't panic. I'm here to help you with all that every single day. Now remember, this is not just the practical advice. This is not just a playbook. I'm giving you some ideas. Liquidity buffer. Hold 3 to 6 months of essential cash. When household leverage is high, liquidity equals optionality. Margin discipline. If you trade, reduce your leverage. Volatility is higher in stressed regimes. Staged, accumulation. So when long-term believers in Bitcoin or select equities use dollar cost averaging to avoid timing risk, they could win. And watch your risk, whether it's T-bills or bonds or whatever. Just be careful of too much diversity and also overexposure. And watch the signals, 10-year treasury yield, exchange inflows, corporate earnings guidance, credit card delinquencies. They're all coming at one time. You need to understand that. Hedge fixed cost. Lock in lower rates if you can. Diversify revenue streams away from just pure consumer spending and exposure. All right, family, I want to hear from you. Which headline worries you the most? Tesla's giant payback? Bitcoin slipping to near 100,000 range? Are you okay with protecting your family and diversifying? And where are you guys watching from? I'd love to know. Put it in the comments. If you found this breakdown useful, smash that like button, subscribe to the channel if you haven't already, and share this with someone who needs a serious talk about money. Remember, this is, though, for education only, not financial advice. Investing is an individual sport. Well, that's your daily huddle. Stay sharp, stay disciplined, and as always, lead, pray, huddle. I'll see you in the next one.